Welcome to the Explainer. Okay, today we are jumping straight into a masterclass on valuation. We're going to run Altria Group through an absolute gauntlet. We're talking the exact rigorous frameworks of legends like Warren Buffett, Peter Lynch, and Benjamin Graham, plus some heavy-duty quantitative modeling. We need to figure out if this $121 billion tobacco giant is a buy, a hold, or a sell right now.
Here is our syllabus for today. We'll kick things off with a quick snapshot, run the company through our three guru lenses, crunch the numbers with our cash flow models, and finally bring it all together for a unified recommendation. Let's get into it.
Section 1. Altria Group Company Snapshot.
To set the stage here, at a recent price of $72.81, Altria commands a massive market cap of over $121 billion. But listen, what we really have to understand as analysts is the context. This is a highly mature company, navigating an industry that's experiencing actual secular volume declines in its main product category. It's a tough spot to be in.
And this breakdown brilliantly illustrates the reality of their business today. You hear a lot about them expanding their smoke-free portfolio with things like on! Nicotine pouches, and sure, those are seeing solid growth. But look at the numbers. Nearly 88% of their $20 billion in revenue still comes from combustibles. The traditional cigarette is absolutely still the core economic engine driving this train.
All right, moving on to Section 2, let's look at this through the Warren Buffett lens.
So how does Altria stack up against the Oracle of Omaha's strict criteria? Surprisingly well on a few fronts, actually. They have an undeniably wide economic moat, largely because Marlboro just dominates with a staggering 59.5% share of the premium segment. Earnings, very consistent. Debt to EBITDA sits at a totally manageable 2.17, and management seems to be honestly evolving, leaning heavily into their moving beyond smoking vision.
But then we hit this massive anomaly. Check this out. Altria's return on equity is a mind-bending negative 243.55%. Now, why is that? Well, years of huge stock buybacks have actually created negative equity on their balance sheet, which essentially breaks traditional accounting math. So, scratch the ROE. As analysts, we have to pivot and assume return on invested capital is the better metric here. And at 32.42%, yeah, that's a number Buffett would absolutely love.
However, Buffett always demands a margin of safety, right? If we calculate their owner earnings and apply a 15% discount to account for regulatory risks and those shrinking cigarette volumes we talked about, our calculations suggest a Buffett-style entry point sits a bit lower, right around the $65.50 mark.
Section 3. The Peter Lynch Lens. Let's see how the growth at a reasonable price legend views this.
Given its $121 billion size, a really hefty dividend yield approaching 6%, and a slightly declining three-year revenue growth rate of negative 1.77%, Altria firmly falls into Lynch's slow grower or maybe stalwart category. I mean, you definitely don't buy this expecting revenue to double overnight. You buy it for the reliable cash.
So the real kicker here is the PEG ratio, which currently sits at 3.37. As a reminder, that's the price-to-earnings multiple divided by the expected growth rate. Lynch heavily prefers a PEG under 1.0 to make sure he isn't overpaying. So a 3.37, that clearly indicates the stock price is pretty high relative to its flatlining growth.
Looking a bit deeper at Lynch's checklist, we see a current ratio of 0.62. Normally, that is dangerously low, but for a consumer staple churning out immense, predictable cash every day, it's survivable. We don't have specific insider buying metrics in our source data, so we're going to assume neutral activity there. Ultimately, Lynch would likely view Altria not as a screaming buy, but as a solid hold for income-seeking investors.
On to Section 4. Let's strip away the narrative and apply the Benjamin Graham lens. Running through his ultra-conservative defensive investor checklist point by point, Altria passes easily on adequate size and that prominent 5.82% dividend. But man, it spectacularly fails Graham's strict balance sheet tests. He wants a current ratio of at least 2, Altria is at 0.62, and moderate price to book? Well, as we know, the book value is negative. Honestly, Graham might be rolling in his grave looking at these balance sheet figures.
And this leads us to a literal mathematical roadblock. Graham's intrinsic value formula requires taking the square root of 22.5 times earnings per share times book value per share. Because Altria's book value is heavily negative, you are literally trying to take the square root of a negative number. The math just outputs an imaginary number. So the godfather of value investing would take one look at this and just pass.
Section 5. Time for the DCF and alternative models. Let's look purely at the math.
For our discounted cash flow analysis, we have to make a crucial, realistic assumption, a negative terminal growth rate. Because of those undeniable combustible volume declines, we are baking in a conservative negative 1% terminal growth. If we assume a standard 9% discount rate for a weighted average cost of capital, our base case DCF outputs a fair value of exactly $68.50 per share.
Now, cross-referencing that with some alternative multiples, we see a fascinating split. An EV to EBITDA of 9.04 is actually relatively cheap for a consumer staple. But on the flip side, a PE ratio of 15.22 really implies the market is already efficiently pricing in this company's reliable cash generation despite the lack of overall growth.
However, if we pivot and apply a dividend discount model, which just focuses on the present value of future dividend payouts, and we factor in their 5.82% yield and historical consistency, we land at a slightly higher fair value of $75 per share. Basically, income investors are the ones setting the floor for this stock's price right now.
Okay, Section 6, Synthesis and Final Recommendation. Let's pull all these threads together.
As this table brilliantly shows, we actually have a really tight grouping of valuations. At $72.81, Altria is trading slightly above our DCF and Buffett estimates, but it's sitting just below its dividend-derived value. The market knows exactly what this is. It's a high-yield cash cow, not a growth engine. The synthesis highlights a massive tug-of-war here. On one hand, you have immense predictable profitability, like a 7.09% free cash flow yield and total dominance in premium market share. But on the other hand, you face undeniable secular risks. The industry is physically shrinking, regulatory threats are everywhere, and pivoting to smokeless alternatives is incredibly tough.
Blending all the insights from our gauntlet today, our final verdict, at the current price of $72.81, is a solid hold. It's fairly valued for income seekers, for sure, but there's just not enough upside for capital appreciation right now. If you want in, the ideal buy trigger price sits lower, right at our DCF convergence point of $68. Buying there gives you that necessary margin of safety against those declining cigarette volumes.
I'm going to leave you with this final, critical thought to ponder for your own portfolio. The dividend is safe today, but can Altria's smokeless products actually grow fast enough to replace combustibles before the cash flow dries up entirely? Thanks so much for joining me on this explainer, and as always, keep thinking critically about the numbers.